94.3 Radio 1 is what you are tuned into, ladies and gentlemen. It'll be nice if you remember this.
Good morning!
Morning! Good morning!
Good morning, Delhi with Sartak.
That is my name, and that is the name of the show. And of course, it is time now for this lovely thing that we call
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
This time, of course, the subject is retirees, how to make your investment work for you with SWP. Our expert, of course, is Mr. Ajay Kumar Yadav. And the question is, a lot of people are retiring in their 40s and 50s. What can be the source of income for these people post-retirement?
Well, retiring early is a decision which should be backed up by smart retirement planning, which is a part of overall financial planning. Basically, smart retirement planning help you understand your future inflation-adjusted expenses and the kind of desired corpus you should have to fund your lifestyle. Early retirement means you have increased number of retired years to live. That is, if someone is getting retired at 45, then by considering the life expectancy of say 80 years, one has 35 retired years, and one should have such kind of corpus to fund the expenses for these number of years. Post-retirement, the source of income will be the returns on your investments. Hence, it is very important to place your corpus or investment in such a manner, especially post consideration of your risk profile, that it should generate enough returns to meet your income requirement, and should also offer flexibility to withdraw to fund your monthly expenses.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
94.3 Radio 1, ladies and gentlemen, is what you are tuned into. It's true, you know.
Good morning!
Morning! Good morning!
Good morning, Delhi with Sartak.
That is my name, and that is the name of the show. And what is up next? This wonderful, wonderful thing that we call
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
This week, the subject, of course, is retirement and how to make your investments work with SWP. And we've got Mr. Ajay Kumar Yadav, who's, of course, our expert. The question today is, how can mutual funds or MF investments help in managing the post-retirement wealth?
Mutual funds offer SWP option, that is a systematic withdrawal plan, wherein one can withdraw fixed amounts at fixed interval, which can be monthly, quarterly or yearly, from the amount you invested in any other mutual fund scheme, and this can help you to have a stable post-retirement income. The basic concept, or you could say theory of an SWP, is that you invest across various asset classes as per your risk profile and time horizon, and withdraw a proportionate amount each month to supplement your income. These asset classes have potential to generate better inflation adjusted returns, and also they are tax efficient to comparison to many traditional asset classes. In traditional investment like PPF, NSC, NFD, you have to withdraw the entire invested amount.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
94.3 Radio 1, ladies and gentlemen. I thought I'd say it a little deeper. Feels a little nicer, no?
Good morning!
Morning! Good morning!
Good morning, Delhi with Sartak.
That is what you're listening to. That is my name. And now it is time for
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
This one's about retirees and how to make your investment work with SWPs. We've got our resident expert, of course, Mr. Ajay Kumar Yadav. And the question is, what is the difference between systematic investment plans or SIPs, SWPs, and systematic transfer plan or STPs?
Okay, let me first brief you about SIP. SIP is a systematic investment plan which allows you to invest a small amount of money over time to build a corpus. The frequency of SIPs can vary. You can do a monthly, weekly, or a daily SIP. Now let's look at STP, which is a systematic transfer plan that allows investors to periodically transfer a certain amount or certain units from one scheme and invest in another scheme of the same mutual fund house. With an STP, an investor can invest a lump sum in one scheme and transfer a fixed amount regularly to another scheme. Mostly investors park lump sum money in debt and then do STP in any equity scheme. And the third one, that is SWP, which is a systematic withdrawal plan, which allows you to withdraw a designated sum of money from a fund at regular intervals. Such a system is particularly suited to retirees who are looking for a fixed flow of income. All these three mutual fund options have different role to play in one financial journey. SIPs help in building corpus over a period of time. STP helps in Rupee cost averaging during market volatility and can support in generating better risk-adjusted returns. And yes, SWP support in getting regular income post-retirement.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
94.3 Radio 1, ladies and gentlemen.
Good morning.
Morning. Good morning.
Good morning, Delhi with Sartak.
That is what you're listening to, and time now for this lovely thing that we call
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
And of course, we've got our resident expert, Mr. Ajay Kumar Yadav with us. This week, we are talking about retirees and how to make your investment work with SWPs. The question is, how can retirees benefit from SWP?
Once you are retired, your investment becomes the source of income. SWP is an option offered by mutual funds that allows you to withdraw fixed amount at a regular interval. Simply put, SWP is a mechanism under which the investor, after investing a lump sum in a mutual fund scheme, provides a mandate to the fund house to systematically redeem units at a regular interval. The amount redeemed comes to investors' bank account to help meet regular household needs or enhance the monthly income of the investor. Ideally, to make SWP work the best, invest in lump sum in a debt oblique hybrid mutual fund scheme. For example, if one wants a fixed amount of 40,000 or 50,000 each month, the SWP feature in a mutual fund can help investor to get it after investing a lump sum amount in the MF scheme. Alternatively, one can set a fixed withdrawal rate each month or on annual basis to meet regular income needs. Under SWP, only a portion of your investment comes back while the balance remains invested and continues to offer an opportunity for generating returns. I would also like to add that SWPs provide the investor a certain level of protection from market instability and help avoiding timing the market.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
94.3 Radio 1, ladies and gentlemen.
Good morning.
Morning. Good morning.
Good morning, Delhi with Sartak.
That is my name, and the name of what's coming up next is
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
The question we are asking this week, of course, is all about retirees and how to make your investment work with SWPs. And the question is how to start an SWP. Mr. Ajay Kumar Yadav is with us, of course. He's our resident expert. So, Mr. Yadav, how to start an SWP?
To start an SWP, one need to fill a form given by a mutual fund company. The form should have amount which you want to withdraw and frequency of withdrawal as per options given by mutual fund company, which can be monthly, quarterly or yearly. Taking into account your retirement age, the expected post-retirement years of your life and the year corpus, you need to decide your retirement income. You have created the corpus over a period of time by investing in different asset classes, either through SIP or lump sum. And now, post-retirement, you can choose SWP option to get predefined income every month. SWP is a convenient feature that gives investors the feeling of receiving a pension. Under SWP, you have flexibility to change your withdrawal amount. That is, you can increase it or decrease it as per your requirement. However, you should always remember that higher the withdrawal rate, the faster will be the depletion. Many mutual fund companies also offer digital tools like the SWP calculator. This can further help you plan your withdrawal well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Good morning.
Morning. Good morning.
Good morning, Delhi with Sartak.
Is what you're listening to, and it's time now for
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
We are, of course, talking about retirement and how to make your investment work with SWP. And the question, of course, is how does an SWP work? And the answer, of course, from our resident expert, Mr. Ajay Kumar Yadav.
A systematic withdrawal plan allows you to redeem your investment from a mutual fund scheme in a phased manner. That is monthly, quarterly, as per requirement. Unlike lump sum withdrawals, SWP enables you to withdraw money in installments. It is quite the opposite of systematic investment plan. In an SIP, you channel your bank account savings into the preferred mutual fund scheme, whereas in an SWP, you direct your investment from your mutual fund plan to your savings bank account. Systematic withdrawal plans allow you to customize the cash flow as per your requirements. On the predetermined date, units from your fund are sold and the money is sent back to your account. In this case, instead of saving or investing a fixed sum of money at regular intervals, you as an investor can withdraw a fixed sum of money from your investment on regular basis.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
94.3 Radio 1, ladies and gentlemen. Are you enjoying yourselves? Smile there.
Good morning.
Morning. Good morning.
Good morning, Delhi with Sartak.
That is what you're listening to. That is what my name is. And what's coming up?
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
We are talking about retirees and how to make your investment work with SWPs. And we've got our resident expert, Mr. Ajay Kumar Yadav, to answer the questions. And the question is, can I opt for a dividend plan instead of an SWP to ensure a steady flow of income post-retirement?
If someone is looking for regular income, then SWP scores over dividend, or now you can say IDCW plans. In case of dividend plan, the payout are not certain. Dividend payments are neither fixed nor guaranteed. A dividend-based plan is where a mutual fund scheme declares dividend from its realized gains. In dividend option, realized gains or profits are made by the fund manager by selling shares. If there are no gain made by the fund house, there will be no dividends at the end of the month. Dividend option can only give you periodic income. Hence, for regular income, SWP are more suitable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Do you remember the frequency? It'll be nice if you remember the frequency. 94.3 Radio 1, ladies and gentlemen.
Good morning.
Morning. Good morning.
Good morning, Delhi with Sartak.
That is what you're listening to. That is my name. And coming up next is
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
We're talking about retirement and how to make your investments work with SWP. And the question that we're asking Mr. Ajay Kumar Yadav, our expert, is how are SWPs taxed?
The tax on SWP withdrawal is solely depend on the category of scheme one is invested in. Systematic withdrawal plans redemption is as per the first in first out method, wherein units first bought are assumed to be redeemed first. Hence, your cost for the purpose of taxation will be considered as per FIFO method. If one has opted SWP from debt mutual fund, then debt fund taxation will be applicable. Debt mutual funds qualify for long-term capital gain tax only if investments are held for 3 years or more. The long-term capital gain tax on debt mutual fund is 20% with inflation indexation benefit on your original investments. If debt mutual fund investments are sold before 3 years, the short-term capital gains are taxed as per your applicable income tax slab. Now let's understand if someone has opted SWP from equity funds. If you redeem or withdraw your investment in equity mutual funds after 12 months, your investment would qualify for long-term capital gain tax. Long-term capital gains in excess of rupees 1 lakh are taxed at 10% currently. If you sell your equity mutual fund investment before 12 months, you will have to pay a short-term capital gain tax at a rate of 15%.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Oh yeah, making the feet move a little, and in the cold weather, good to get the circulation going.
Good morning.
Morning. Good morning.
Good morning, Delhi with Sartak.
Is what you're listening to, ladies and gentlemen. Time for
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
We've got our resident expert, Mr. Ajay Kumar Yadav, with us, and we're talking about retirement and how to make your investments work with SWP. The question is, which mutual fund can I have an SWP in to have a peaceful retired life?
The answer lies in investor risk profile. If you are a conservative investor, then you can pick up debt funds. And for moderate risk profile investors, balanced funds will be appropriate. It becomes very challenging to generate inflation adjusted returns from debt mutual funds. But yes, balanced funds have potential to generate better inflation adjusted returns. Balanced funds have 65 to 75% exposure in equities and 25-35% in debt. Balanced funds are considerably less volatile than diversified equity funds. An SWP balanced fund or balanced advantage fund is an ideal investment option for investors to get monthly income from their investment and at the same time see their investment grow in value.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
94.3 Radio 1, ladies and gentlemen.
Good morning.
Morning. Good morning.
Good morning, Delhi with Sartak.
That is my name, and we're doing the polite thing by wishing you, yes, of course. It is time now for
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
We, of course, are talking about investments and how to make your investments work post-retirement with an SWP. And we've got our resident expert, Mr. Ajay Kumar Yadav, with us. The question we're asking is, what are the things that an investor should be careful about before going for an SWP?
SWP option is to meet your monthly income requirement and should preferably opt it post-retirement. If someone has regular cash flows, then should not opt for SWP. One must know SWP is not a product. It is a process of investment withdrawal. Higher the withdrawal rate, the faster will be the depletion of corpus. One must remember the investment corpus has to fund entire post-retirement life expenses. And it should be utilized wisely to live worry-free life. I think investor can look forward for financial advice on SWP withdrawal from their financial advisor.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
It's always nice to wish people early in the morning, no? So we're going to do that.
Good morning.
Morning. Good morning.
Good morning, Delhi with Sartak.
That is my name. That is what you're listening to. And it is time now for
Mutual Fund 101, powered by UTI Swatantra, an investor education initiative by UTI Mutual Fund on 94.3 Radio 1.
We've, of course, got our resident expert, Mr. Ajay Kumar Yadav, answering questions about retirement and how to make your investments work with SWP. The question is, how are a mutual fund SWPs better than traditional investment options in terms of managing retirement income?
SWP from mutual funds have multiple benefits over traditional investment options. One can opt SWP from a wide range of available mutual fund schemes like debt, hybrid and equity. With diversification in place, these schemes can generate much better inflation adjusted returns than traditional fixed income investment options. SWP is a process of redeeming money from your mutual fund investment in a periodic manner. This ensures that a fixed amount is credited to your bank account on a fixed date periodically, just like salary income. The first key benefit of SWP is rupee cost averaging. Due to rupee cost averaging, the investor even benefits when he withdraws the money from its investment. To understand this, let's assume Mr. A has invested rupees 5 lakh in a scheme with NAV of rupees 50 and opted for the SWP of rupees 10,000 every month. With the changing market dynamics, the NAV for the scheme changes every month. After 5 months, he has withdrawn rupees 50,000 in total. That is 10,000 a month. So the principal amount is reduced to 4.5 lakhs. However, the value of investment will be higher. In short, due to rupee cost averaging under SWP, investor will turn benefit even while withdrawal. Therefore, you earn even as you keep on withdrawing funds. The second benefit is that SWP is more tax efficient than traditional investment option like a fixed deposit. When an investor withdraws through SWP, the tax liability reduces to a great extent as he has to pay tax only on the gains. And after 1 year, it further reduces as now he has to pay tax at the lower rate of 10%. Hence, overall SWPs are beneficial than traditional investment option as it provides definite inflow of cash monthly and earns returns more than traditional investment option with the tax efficiency.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.